Hello everyone, here is a brief introduction to accounting for a retail business. How the path of goods traditionally works for merchandisers, for retailers, is that a manufacturer produces the goods. In our case, we're going to go with Utz chips. Utz produces the goods, but they don't sell directly to the retailer. Typically, it goes through a middleman, and in this case, our middleman is going to be River Valley Foods. So Utz makes the chips, packages them, and sells them in gross to River Valley Foods. They're obviously not going to sell them for the same price that it costs them to produce the chips, so when they sell them, they're going to sell them at markup. River Valley Foods, the wholesaler, has all of these chips in inventory. They sell it to the local grocery store. So let's go with Price Chopper, Price Chopper being the retailer. Again, River Valley is not going to sell these chips for the same price they purchased them for from Utz, so they're going to mark up these chips as they sell them to Price Chopper. And finally, Price Chopper, the retailer, is going to sell them to you and I, the consumer. They won't sell at the same price that they had, so that is going to be another markup. When a company in this chain, in this case the retailer, when they buy them from the wholesaler to sell them to the public, they can't expense them at the time that they purchase them. By accounting rule, when you buy inventory that you intend to resell later to the customer, you have to hold it in an account called merchandise inventory. This is an asset account. It's an asset because it's something you're going to use to make revenue in the future. In fact, it is a current asset because you plan to sell any given one of those products that you purchased within the next year. The big hang-up with merchandise inventory is you do not value it at its resale price. So if you're Price Chopper, you don't value your inventory at the price you plan to sell it to the customer for. You value it at the price that you paid to purchase it, in this case from the wholesaler, in the first place. So if Price Chopper is buying a gallon of milk for $1.50 and they plan to sell it for $2, well, its valuation that they carry it in the merchandise inventory account for will be $1.50. When they do actually physically sell it to the public, that is when they can expend it. That's when they can record an expense. And that expense for a retailer is called cost of goods sold. Anytime you buy an item, it goes into your merchandise inventory account. Every time you sell an item, it comes out of merchandise inventory and gets recorded as a cost of goods sold. There's a concept for retailers called gross profit. It is essentially the amount of markup that you are making before you sell it to the next person in this supply chain. Take Utz for example. Let's say Utz pays 50 cents to manufacture a bag of chips, and then they sell it to River Valley Foods for $1. Well, how did Utz make out on those chips? They had a dollar sales price. Their cost basis, or their COGS, was 50 cents, which means they made 50 cents profit off of each bag of chips. River Valley Foods, who paid $1 for these chips from Utz in the first place, goes ahead and sells them to Price Chopper for $1.75. How did they make out? They had a $1.75 sales price. Their cost basis, or their COGS for the chips, was $1, which means they make 75 cents profit off the sale of each bag of chips. Price Chopper paid $1.75 for the bag of chips, and then they turn around and sell it to the customer for $2.60. How did they make out? $2.60 sale price minus the $1.75 in COGS means they're turning a profit of 85 cents per bag of chips that they sell to the public. And what about the customer? Well, soon they realize that the bag of chips that you're paying $2.60 for in the grocery store only cost 50 cents to make originally, and it makes you want to faint when you see your grocery bill. How do these companies keep track of what they have in inventory? There's multiple systems, and the first system is called the periodic inventory system. In the periodic inventory system, a company has to keep track of all of its purchases, and then at the end of each period they go through and they count their storefront or their warehouse or wherever they keep their goods, and they use the formula of beginning inventory plus purchases minus ending inventory equals cost of goods sold, which makes sense. Your beginning inventory plus your purchases is the total amount that you had available for sale during the month. If you subtract out what you have left, that has to be what you sold. Small businesses will use the periodic inventory system because It doesn't require you to have to go through and do a bunch of stuff with your inventory. You just keep track of your purchases and you do one count at the end of the period. The problem with that is you're only doing one count at the end of the period. So if at any point someone says, how much inventory do we have left on the shelves? There's no way from looking at the books the true number of that. So the periodic inventory system used to be used a ton. It is declining rapidly in popularity for that very reason. It doesn't give you very up-to-date, useful information. That is opposed to the perpetual inventory system. So the perpetual inventory system keeps a running record. And by that I mean anytime there's a transaction involving merchandise, whether you're buying it or selling it, the company's merchandise inventory account changes with each transaction. How is this possible? Best example I have are the checkouts that you see at your everyday grocery store. You go through, you scan the item, and sure, the number that it costs you pops up on the screen, but that's not all that's happening. It is telling their system what you're buying, so it can remove it from the company's inventory. So not only is it ringing you up, it's adjusting the company's books at the same time. And when this came around, it really gave rise to the perpetual inventory system because the technology made it much easier for companies to use this method, to change their inventory every time they had a transaction. And then technology got even better. And now, with your smartphone and a few apps, even the smallest of businesses can scan QR codes, run credit cards, and with that keep track of their own inventory. So the advent of all this technology has made the perpetual inventory system much, much easier to use. And because it gives you up to the minute quantities and values of your inventory, it's preferred by pretty much every retailer. 90-something% of retailers use the perpetual inventory system, and I think that number is only going to get higher. In the retail world, most transactions between the higher up businesses, from the manufacturer to the wholesaler to the retailer, where there's large quantities of goods getting exchanged, that exchange doesn't happen in cash. That transaction won't happen in cash. Typically, you call, you place your order, the order comes to you, and when the order comes to you, there's an invoice. You get billed for it. And on that bill, they're going to give you something called credit terms. And the one that we have here is 210 and 30. What does that mean? Well, the first number is the percent of discount offered. So if you're buying inventory and it says 210 and 30, that means the 2 means you have a chance to get 2% off. How do you get 2% off? By paying within the discount period. The second number is the number of days you have to pay in order to get that discount. So 210 means 2% off if you pay within 10 days. The whole second half of these credit terms tell you how long you have to pay off this debt in total. And 30 means the net balance owed to the vendor, to the creditor, is due within 30 days. So 210 and 30. 2% off if you pay within 10 days. The entire balance is due within 30 days. That's how credit terms work. There are costs associated with retail transactions that aren't simply the cost of goods. There's extra costs that can go into the acquisition of merchandise inventory. Shipping costs is a big one. Who pays to have all that stuff shipped from one place to the other? That could very much be the retailer buying from the wholesaler that has to pay shipping to get those goods to their storefront. Well, if that's the case, then shipping costs have to be included in the cost of the inventory. There could be things like insurance. If they're sending you a big old box of goods or big old truck full of goods, you don't want it to come to you completely damaged and unsellable and be stuck with it. So you pick up insurance on that shipment in case something bad happens. You can get your money back. Again, there's a necessary cost that you have to pay to acquire that inventory, so it gets included in the value of inventory. But the catch is all of these extra costs, the shipping, the insurance, any other thing that comes along that's any cost besides the actual purchase price of the inventory, is not eligible for the discount. So even though it says 210 and 30, doesn't mean you can get 2% off of everything. You only get 2% off of the value, actual face value of the inventory that you're buying. Ownership, really fast, will be expressed in two different ways. They are FOB, which stands for free on board, FOB shipping, or FOB destination. And it tells you when it is legal for a company to put that inventory on their books when they purchase it, or record the expense for selling it if they're the one selling it. FOB shipping means whoever is buying takes ownership of the goods as soon as it leaves the location of the seller. So if you are a wholesaler, as soon as you ship that out to the retailer, you can record the revenue. You can record your transaction. If you are the retailer selling to the public, well, you can record it right then and there because they're obviously walking out of the store with their groceries or their shoes or their clothing or whatever they're buying from your retail location. FOB destination means that the buyer doesn't assume ownership of the goods until they actually arrive at their location. So if you are a retailer and you are buying from a vendor that is far away from you and it's going to take days for it to get there, if you have FOB destination, that means you don't have actual ownership. You can't put it on your books until it arrives at your location. Returns and allowances are another big part of inventory. We've all returned something to a store at some point. Same thing happens between vendors and retailers, etc. Return means you have goods you don't want anymore. You have some option to return those to the seller. Maybe you have a money back guarantee, or maybe it arrived in a damaged condition and you don't want it anymore, so you negotiate a return with the seller. However, you get there, a return means you have to physically send the inventory back to the person that you purchased it from. An allowance means you keep the inventory that was sent to you that you no longer want, but they credit your account for it, so you no longer have to pay for it even though you have possession. This one typically only happens if goods come and they are damaged in a completely unsellable, unfixable condition. The example I always use is you're shipping paper towels to a grocery store, they're not properly stowed away, and they get soaked. Why would the vendor want to get soaked, moldy paper towels back? They wouldn't. So they would just give you an allowance. They would just credit your account and say, you get to dispose of these no good paper towels anymore. Regardless if it's a return or an allowance, you're not going to pay for it because you don't have the goods anymore. So if you have a return or an allowance, you reduce your liability to your creditor. Or if you're the one selling to the public and the public returns it, well, you reduce the amount that you can receive from the public because they're not going to pay you for something that they returned. Discount purchases. Revenues and expenses are recorded at the time ownership is transferred. So if you are a retailer, if you're a storefront and you sell to the public, as soon as you sell, you get to record the revenue for the amount of money you took from the public and the expense related to how much you paid to acquire those goods in the first place. However, if you are selling large quantities of goods to one entity and you're selling on account with these terms, well, you're not going to get the payment till later, which is a conundrum because you have to record the revenues not knowing if the person you're selling to is going to get the discount or not. So should your company assume that the person that's buying from you is going to pay within the discount period? It's based on historical precedent. If you've sold to a customer before and they typically pay with a discount, well, that's precedent. That's happened. You can assume that they're going to pay within the discount period. The same concept applies when you purchase something. If you typically pay during the discount period when you make a purchase, do you assume that you're going to get the discount? Well, if that's something you do 90-something% of the time, yes, you can assume that you get the discount. So it's really all up to what's happened to your business before. The options that we have here are called the gross method and the net method. The gross method is assuming that the discount is not going to happen. So if you're making a purchase and you're recording under the gross method, you're assuming that you're not going to pay within the discount period. If you're making a sale and you're using the gross method, you're going to assume the person that you're selling to is not going to pay within the discount period. The opposite of this is the net method, where you assume that all discounts are going to happen. So if you buy something, you assume at the time that you buy it that you are going to pay within the X amount of days to get a certain percentage off. And when you sell to somebody else, you assume they are going to pay you in a timely manner in order to get that discount. And again, the option to use the gross method or the net method is really based on what's happened to your company beforehand. But what happens if you don't know? I mean, new businesses start all the time. businesses that have existed start dealing with new vendors or new customers all the time, sometimes that information isn't there. And when you don't know, the best thing to do is abide by the gap conservatism principle. What does it mean? Easy enough. When in doubt, always record transactions in the way that is the worst for your business. That way you can't get in trouble for them saying you're falsifying revenues or you're, under recording your expenses. Record in the way that is least favorable for you. Well, what is the way that's least favorable for a company? That company never gets a discount on anything they buy, so they pay as much as possible for their inventory. And that when they sell goods, the customer always gets the discount, which means they pay as little as possible back to your company. By doing so, you record the highest possible expense you can get, because you're paying the most you possibly can for inventory, while receiving the smallest amount of revenue you can get. So the gap conservatism principle essentially states that always assume you're going to pay full price on purchases, and always assume that your customer is going to get the full discount at the time that you make the sale. And doing so, again, results in the least profit because you have the lowest possible sales revenue and the highest possible cost of goods sold. Retailers will classify their expenses a little different than service businesses. Namely, cost of goods sold is such an important number for retailers that you make it into its own thing. Cost of goods sold doesn't get bunched with any other expenses. You want to have it presented on your income statement as its own individual line because it's going to be the biggest expense for most retail companies. All of your other normal operation expenses, your salaries, your supplies, your insurance, your rent, advertising, all of these things are normal cost of the business. And every normal cost of the business besides cost of goods sold is going to be classified as your operating expenses. So those get reported separately from your cost of goods sold. And then if you have any other expenses that your business is paying which aren't absolutely necessary for your business to be in operations, and the big one is interest expense, you would record that as an other expense. So you group your expenses into these three different categories: your cost of goods sold, your operating expenses, and your other expenses or your non-operating expenses. And it lets people that look at your financial statement, your income statement if you will, get the most useful information out of there for what they want to know. Are you getting enough markup on your goods? Are you paying too much for administration? Are you buried in debt and paying too much interest? By separating these numbers into different categories, it lets someone look at your income statement and make a quick determination about the financial position of your company.